instead of just looking at the oil price, we'd also be looking at the equity market. And we would define the biggest rise in interest rates and the biggest inflation shock from 40 years as the great escape for equities. And the reason why we say that is even though there's lots of doom and gloom forecasts, the US economy avoided a recession. And the reason for that is threefold. Number one, we've seen that labour markets remain very strong indeed, and that's offset the increase in interest rates. Number two, the Federal Reserve has now indicated that it starts to cut interest rates. And number three, there's a very important theme that's been driving markets. That's, of course, the mega caps and artificial intelligence. If you put those three things together, that's been one of the key reasons why we would say that the global economy and equities have rallied. But going back to your point about oil, the reason why oil has been a bit weak is probably due to the fact that the Chinese economy, a big consumer of oil, has been fairly weak as well. Saying that, when we look at markets, they're generally a little bit more optimistic and it's avoided that volatility.
And let's bring us up to the present day where we've seen, I guess, Iran's, biggest involvement in what's gone on in the Middle East over the course of the last year, in the last 24 hours. What has that done and what predictions are you making?
Well, there's been lots of red lines that have been broken this year between Israel and Iran. We saw back in the 13th of April, we saw the first ever Iranian drone attack on Israel proper. We also saw last night, on the 1st of October, another attack from ballistic missiles, more than 180 missiles, or the Pentagon says 200 missiles. And of course, we've had alleged attacks from Israel, first off on the 1st of April in Damascus, the Iranian embassy there, where two Revolutionary Guard members have been killed. And also, there's been Israeli attacks in Lebanon. And at the end of September, we saw the attack against Hassan Nasrallah, who was killed. He was the leader of Hezbollah. So there's been lots of red lines that have been broken. And I think looking forward on the predictions, really, it seems to be this tit for tat ratcheting up in escalation between Israel and Iran. Every time Iran attacks Israel, Israel responds. And at some point, it could either escalate or it can de-escalate. And I think from both sides, you could argue that the Israelis might see this as an opportunity. This could be an opportunity given that we saw that Lebanon, it seems to be looking at the leadership there has gone, and all these pager attacks that they look ripe for the Israelis to move a little bit further into Lebanon, at least temporarily. And I guess the Iranians have to respond because domestically they want to shore up support for the regime, but also they need to have the support of their proxy allies, whether it's Hamas in Gaza or Hezbollah in Lebanon. They have to show that they can respond to the Israelis. So the question is, where does it stop?
And what does all this mean for the global markets, for the global economy? Where do we sit in sort of prediction terms, given what you've just said, and the fact that there doesn't appear to be any obvious resolution to all of this?
Yeah, for the moment, the markets have basically completely ignored it. I know the media headlines look poor, but for markets, it hasn't really mattered. And that's probably twofold. Number one, we can see that the area that's been attacked, like Israel, is not affecting oil supplies. It could affect Iranian oil supplies in the future if Israel does attack Iran, and Iran was to say mine the Straits of Hormuz, where about 20% of oil and gas comes from, seaborne anyway. Then that could be a ratcheting up in escalation of risks, and that could affect markets. But for the moment, it has not affected global oil supplies, and the oil price the impact has been fairly limited. Brent is trading around $75. That's not much given that what's going on. And I think the second reason is what's been going on with the Federal Reserve. The Federal Reserve has become much, much more dovish than other central banks like the ECB or, for example, the Bank of England. What that means is that the dollar has weakened since the end of June, and the weaker dollar has given a little bit more liquidity into the financial system, and that's given you a little bit of a cushion against some of these headwinds that are coming from the geopolitical stages in the Middle East.
Before we get on to what might happen, can I just ask you sort of specifically how much impact anything that goes on in, I guess, Lebanon first, with on an international scale, perhaps one of the lesser lights in terms of its might, and Israel. When whatever happens in those two countries do they ever really impact the global markets? We'll come to Iran in a moment, but first those two.
Those two on their own would not affect global markets. As I said, it does not affect the oil supply, although there's shocking humanitarian issues here. It only affects global markets if it involves Iran, because Iran is a big oil producer and it's by the Straits of Hormuz. It could lock in a lot of the oil that could come out from, say, Kuwait, Iraq, and even the Saudis to some degree. That's where Iran could play a major impact in terms of global markets. But for the moment, Israel attacking Lebanon or sadly in Gaza does not have a massive impact on markets.
Well, let's go there then. Let's talk about what Israel's threat to Iran was prior to the missile attack we saw in the last 24 hours, where they actually had time before the attack happened to say, if you do this, we are going to attack either your oil reserves or your nuclear facilities. Let's talk about if the decision is to go with the oil reserves. And we'll start with that point, and then we'll come on to what Iran has said will happen if that's what Israel does. So where do we go if that is Israel's decision to go after Iran's oil reserves?
It's dangerous here to speculate what they will do or what they won't do, but I do suspect, and there's another element here, we're running very, very close to the US election on the 5th of November. I'd very, very much doubt that the Biden administration or Harris administration would want the Israelis to attack oil reserves. That leads to a spike in the oil price this close to an election. So whether they go ahead with that, I don't know. What sort of control the Americans have in that, I don't know. But I suspect it'd be quite a bit. A lot of this could be rhetoric, and basically both sides are warning the other. If you attack us, this is what potentially could happen. Like I said, these red lines have been broken, so all bets are off. But I would like to think that there will be some sort of de-escalation, because at the end of the day, the Iranian regime can't really afford to take on Israel with their capabilities, and I don't think the Israelis will be able to do that without US and Western support. So hopefully there could be some de-escalation before it gets too far.
Fingers crossed. But worst case scenario, I mean, what are we talking here? What are we talking for the man on the street? In the UK or in the US or anywhere across, say, mainland Europe, which that certainly has vested interest in what goes on in the Middle East.
I think the man in the street will obviously notice if oil prices shoot up. At the moment, that's not the case. It will be in the media headlines, but it's not going to have an economic impact or market impact to their portfolios. So, like I said, at the moment, there are a lot of positives that are coming through that are helping equities offset this risk from the Middle East. And some of these risks from the Middle East we've not seen before. But like I say, the global economy is actually doing okay. We've got central banks cutting interest rates. The dollar is starting to weaken. And even the Chinese central banks and the Chinese government is really starting to step up the stimulus as well. And we've seen the equity markets in Hong Kong rally very, very sharply indeed. And of course, behind all of these, we still have the AI theme, which is still going strongly. So there are a lot of reasons to remain supportive of equity markets. But the key here is, how do you hedge against this risk?
At what point might what's going on in the Middle East negate those positives, as it were? I mean, Israel's threat is one thing. Of course, we can all hope that that these things de-escalate. But then Iran's response, so they say, is that if Israel does what it says, then they will, and I quote, destroy all the oil refineries across the region. I mean, that would be an extraordinary shock to the world, wouldn't it?
Yes, but I mean, the way I would see this is waiting to see the actions. Uh, I strongly suspect that if Iran was to, say, mine the Straits of Hormuz, they'd cut off the revenue stream for their regime. So they'd be cutting off their nose to spite their face. So I'm not sure they'd necessarily want to go down that road. And I guess Israel probably wants backing from the West. So I think these are considerations, and you have to kind of separate the rhetoric from the actual actions. And I think what investors can do now is to try and hedge their portfolios. And what couple of ways to do that would be: one, within the equity bucket of their portfolios, to own a little bit more in terms of energy stocks. If, for example, we do see a spike in energy prices, we will probably see energy stocks performing well. Aerospace and defense stocks look possible, but it's worth bearing in mind their valuations are very expensive. And of course, a lot of that is dependent about the outcome of the US election. We have seen that President Trump has said that he wants to have a peace deal between Ukraine and Russia, and if that was to happen, there'd be less money being spent on defence. Kamala Harris wants a path to victory, and probably presume means more spending in that sort of area. So you would be exposing yourself a little bit to other risks, say the US election. There are other ways to hedge portfolios. For example, gold. Gold has been performing very, very well indeed. Typically performs in periods of geopolitical uncertainty. But there's another secular reason to buy gold, and that's because central banks, particularly those coming from China and Russia and the Saudis, they've been buying lots and lots more gold because this follows the Russian invasion of Ukraine. That's when the Western authorities confiscated about 80% of Russians' foreign exchange reserves at its central bank. So what we have seen is a lot of other central banks, particularly from the emerging economies, wanting to buy gold because they fear that their reserves could be confiscated. And one other final area that you could hedge your portfolios is really within the fixed income bucket, not necessarily conventional bonds, but you might want to own inflation protected bonds, so linkers in the UK or tips in the US. These generally do well these do well when inflation heads up and certainly outperform conventional bonds. And of course, if oil prices go up, they're likely to do better. So those are areas that investors should be thinking about in terms of hedging against this known unknown risk in Rumsfeld terms.
I have just two further questions for you. The first, you very briefly mentioned Russia, Ukraine there. Does that, generally speaking, as a war have, you can compare two horrible situations, as it were. Does that, generally speaking, as a war have more impact on the globe, on all of us on the street, than what's going on in the Middle East?
Well, it did at the start. I mean, when we had the Russian invasion of Ukraine, Europe had to source gas from alternative sources like liquid natural gas, and we all saw it. We saw our gas prices shooting up. We also saw energy prices shooting up. In crude oil. It did have an impact, but we've had a couple of years since 2022 to try and raise storage, sourcing gas from alternative areas, the US or Qatar. So we have had some time to put in provisions or a contingency against the escalation of what's going on in Ukraine and Russia.